So Andrew, welcome to Sydney. It hasn't been that long, but
it just feels like only yesterday. The weather's got worse.
Well, actually, Mel, our head of marketing, is going to kill me because we brought you out into the boardroom. The acoustics are not great, the light's not great, but I thought it would be a shame to hide you in some little room. After, I think you've been off the plane for what, 2 hours?
About that, I could do with some daylight. The vitamin D levels are a bit subdued, I think.
Okay. Well, look, straight in, the first day is always the easiest one when you come over here because you're running on adrenaline, so we thought it would be good to get you hot off the boat, as it were, fresh off the boat. And actually, last night, spent a bit of time going through a presentation you did a few days ago. I'll just sort of give the highlights, and maybe you can just elaborate on that to set the conversation, and then maybe we can talk about the implications for various types of investor. But the thing that you seem to be the most energized about at the moment is capital flows in the US and trust in those debt instruments. And with an emphasis on what happens in August, something happens, something that you're talking about a lot, and then there's some policy implications and finally some implications for investors. What would you add to that?
Well, I think if we were to wind the clock back to I suppose a week after the inauguration and President Trump has started changing the rules, should we say, and we made a big presentation at the time that to invest in financial markets domestically you kind of had to trust your government, that the rule of law, that rules would be enforced, that they'd be fair, but actually that's normally quite a low bar to invest domestically because you generally trust the country in which you live. But to invest internationally is a whole other thing. You've got to trust other people's governments who may have different objectives to your own government. Rules may be different. And I think one of the themes that we arrived at quite quickly in Trump 2.0 was that the rules could change, sometimes without a lot of thought. And to me, the sort of low point of all of that was that Rose Garden presentation on reciprocal tariffs, which was, to be frank, the maths was so wonky, it was really rather worrying, and you were left thinking, you can have no trust in the global financial system at this point. It's being pulled apart. Everybody's going to take their money back. So all what I call the stodgy savers, Japan, China, Germany, who've been providing funding to the deficit countries, principally the US, but UK, New Zealand as well. So I've often thought US exceptionalism was just the US's ability to borrow other people's money and spend it for them, which essentially was what was going on. And we thought, if you had a breakdown in trust, those conservative Germans, conservative Japanese would stop putting their money in the US. The US would find actually that the money was being pulled out. It would have to run a current account surplus in order to fund those outflows. And to produce a current account surplus would be a collapse in imports, probably a collapse in the dollar to encourage exports. It would really be quite painful. And I actually worked during a repatriation trade in the Asian financial crisis. That was about foreigners attempting to get their money out of the Asian region. In fact, most equity investors didn't. By the time they tried to move the money, the price had collapsed 60, 70, 80, 90% in some cases in dollar terms. So it's actually most of the heavy lifting on reducing Thailand's foreign liabilities, for example, was done just by collapsing the price. There weren't actually many flows. The markets just seized up. And that was the big fear, that could perhaps happen if President Trump became so outrageous that people lost trust. And then there was a sort of halfway house where people just didn't put as much money in the US. The US has a current account deficit. It's also an economy that likes to invest money overseas. So it needs this constant flow of money. And it almost became a mathematical exercise in that you could say, well, if the capital flows were to halve, the current account deficit has to halve. You know what the import elasticity is. You know how sensitive US exports are to world trade trends, and it really, it's something you could do on a spreadsheet, and you'd come up with a US GDP forecast. So if the capital flows fell 90%, you'd be looking at a 5% decline in US GDP. Now that sounds horrendous and an outlandish forecast, but that's exactly what we saw during the Asian financial crisis. So these things do happen. Obviously, less extreme would be perhaps capital flows reduced by a third, and then you'd be looking at a mild recession. And so you had this sort of spectrum of possible outcomes. And that's where I think we spent probably February. We knew we weren't in the major repatriation trade because markets were still functioning. We hadn't had that Asian financial crisis style collapse. It looked like the capital flows were beginning to reduce, and we spent a lot of time just mechanistically trying to look at how we could measure those capital flows. Now, the US statisticians do measure them, but they do it quarterly with a 2 to 3 month lag, which isn't much use in a portfolio sense. So we tried to build a weekly series from the settlement data, and I think it more or less captures what's going on. If anything, it tends to be a bit conservative. But that's where we sort of were, and we could see the capital flows subsiding in February. Things looked a little bit wonky for a while, and that was starting to affect the economy. But then in March we saw the capital flows coming back, and our data suggested they came back quite strongly. We have now had the official US flow of funds data that includes data on this, and somewhat surprisingly, the first quarter of 2025, despite all of the news and all of the fears and all of the talk of the regime change, they were actually the 6th largest capital inflows on record into the United States occurred during that quarter, principally in March. So the world actually didn't change. If anything, it was one of the biggest quarters for capital inflows and indeed capital outflows by US investors we'd seen since the little modern era of big capital flows, which I'd traced to be in the mid-80s. So my big conclusion was actually nothing has changed yet. Foreigners have continued to put money in. That's been recycled through the US credit system. We've seen a drawdown in the government's cash balances, which has created more liquidity. For all of the talk about import prices going up with tariffs, import prices have actually come down recently, and that's helped the inflation data, so we could even talk about Goldilocks. So actually the world didn't change at all in the inauguration. We thought it was in February. Thankfully did the work about the capital flows to sort of think, it's not the end of the world. But I think I've been surprised just how active foreign investors have been in the United States in the last 3 months.
And because they're buying things or not buying things, or
the equity flows are there.
Yeah.
I suspect probably more private than public markets, but that detail isn't available in the data. We can't see that. What's really surprised me, though, was the flow of money into US Treasuries. Now, equity investors, you could kind of say, right, they saw the dip in February, we're programmed now to buy the dip, so equity investors, they've got a bad dose of FOMO, had to bought the dip, scared of losing out. But the purchases of treasuries is very interesting, given everything we were hearing was a Japanese bank pulling out of treasuries. You were getting these snippets of information, but actually the objective data says it was one of the biggest quarters for capital inflows into treasuries. And I think there's a number of reasons for that. One, because of the threat of tariffs, there was a surge in world trade. Every company in the US tried to get their imports ahead of the imposition of tariffs. That meant that Asia had very large trade surpluses. They had to put the money somewhere. And the traditional home for this is treasuries, and apparently it still was. And we've seen capital outflows from the Asian region. I mean, one of the, ironies, by imposing tariffs or threatening to impose tariffs on so many of the US's not just trading partners but geopolitical partners in the Asian region, I think it's told the residents of the region that actually you're on your own. Big Brother, the United States, was going to mixing metaphors here, but the American Navy is not going to ride over the horizon to save you if there's a problem. So actually, you're on your own when it comes to dealing with your rather large neighbour, China. You're going to have to, sounds a bit of Game of Thrones here, but bend the knee a little bit. And that seems to have destabilised or disturbed savers in Asia, and we've seen them taking money out of the Asian region, particularly as the currency has appreciated under the weight of US capital inflows. That Asian investors went the other way and bought the US, I think, diversifying out of their own region. But also I think the Europeans have a lot to do with this as well. Two things going on there. One, Europe quietly drifted back into something resembling quantitative easing. It wasn't that the European Central Bank has been buying bonds, but what the European Central Bank has done is bring down the short end of the curve, bring down short-term interest rates, guarantee that rates would stay low and actually potentially continue falling, and also provide a little liquidity at the short end. Certainly the unwind of the LTROs from the pandemic and the Euro crisis in mid-2010s, they haven't been coming down anymore. So the European Central Bank has put a little bit of liquidity in, it's brought down the cost of short-term funding, and European banks have been buying the long end of the curve like it's going out of fashion, simply so they can ride the curve. And that creates liquidity. It is a form of quantitative easing. It was pioneered actually by Volcker during the Latin American debt crisis in the mid-80s. It was refined somewhat by Greenspan after the S&L crisis in the early 90s. And here we see the European Central Bank creating money in that way. And some of that money will have been attracted to treasuries, particularly as European yields came down. But there's another, I think, sort of rather quirky thing going on in Europe. European governments are so determined not to advertise just how big their budget deficits are in reality that they're hiding their spending in off-balance sheet vehicles, defence funds, the European Bank for Reconstruction and Development, the European Investment Bank. And if it's anything that's not a straightforward vanilla government bond that looks like it's funding a deficit, they've been trying to hide behind that. And you can see the politics of that and why they're so keen for the optics of the budget deficits to appear that way. But it creates a particular problem in that many of the bonds they're issuing are not actually very liquid in an investment sense. And so people operating in the swap markets, these things are no use as collateral, they're not liquid. For the major banks that need to hedge positions, often buying or shorting the long end of the curve according to what's going on in their own balance sheet, an EIB bond is of no use to them whatsoever. And so when you look at the major sovereign bond markets, US Treasuries, still very liquid. JGB market, a bit less liquid, and hasn't been a great investment year to date. Bunds are just illiquid because the Bundesbank and the German insurers and banks own pretty much all of them, so there's actually very little free flow. You're really only left with Italian bonds, French bonds, and French bonds obviously had their problems last year, or gilts. And it hasn't been a great environment for gilts, given all the politics in the UK. And then you've got all of this illiquid special stuff that just isn't much use. And I think for those investors in the long-term savings institutions, the pension funds, particularly the insurance companies that need long-term debt securities, there's use another overused phrase, there's a bit of a Tina going on. There isn't an alternative to treasuries. European Central Bank did QE, made that even worse. Treasuries had a bid, a surprisingly strong one.
So what you're saying is, amongst this uncertainty, you've got some excess cash somewhere. Money always flows to the path of least resistance, where the liquidity is. So it's a story of unintended consequences.
I think lots of unintended consequences that have sort of come together to create actually a world that didn't appear to change. If anything, exaggerated its normal behaviour.
So what we observe sometimes is the equity flows, which have been back and forth, and there is a kind of end of US exceptionalism feel to it. But what you're saying is, in the financial plumbing, there has been these sort of capital inflows, and you're just sort of talking about what you observe. What we've seen at a yield level or a price level is actually sort of, a little bit volatile, but rocking around that sort of, 4.2 or something to, up towards 5% at some point. It begs the question, what would it have been like otherwise? You would have potentially had higher yields, because in that environment, you'd probably expect lower yields, no?
I think there were three factors supporting treasuries. There was European quantitative easing, which just creates liquidity in the world, and some of that found its way into treasuries, and I suppose actually four things, including the Asian trade surpluses as well. Then you had this idiosyncratic thing of treasuries being the only liquid market. But I wouldn't understate the importance of the total lack of issuance. We've sort of forgotten about the debt
Yeah.
ceiling.
Yeah.
But actually, the stock of treasuries outside of the US banking system fell by about $80 billion year to date. So the Federal Reserve was selling a few treasuries, surprisingly few in fact, but it was selling a few treasuries through this half-hearted quantitative tightening they're doing. There was no issuance by the Treasury at all because of the debt ceiling. And then the US banks bought quite a lot of bonds, bought a couple of $100 billion worth of treasuries over the course of the year so far. And I think that was in anticipation of the change in the SLR, the supplementary loan ratio, that would allow them to have, and also they probably perhaps took a little bit of a speculative position. So the bond market has basically stayed still. I guess the average yield pretty much has been fairly consistent this year, despite a reduction in the float outside the banking system, this idiosyncratic flow, and just this Asian trade surplus, European QE, which would have created a reasonably positive environment. And also, we've had some deflation coming out of China that's seeped into the US goods markets through the usual routes, through trade routes. That won't have hurt treasuries either. So the fact that treasury yields haven't come down, I think, tells us that this is quite a fragile market. And in particular, that if we were to test that market with some issuance, you could expect possibly quite a sharp pickup in yields. And I think policymakers globally are scared of that. There was a little wobble in bond markets in May that started in Japan. A lot of people got excited by that. I think the real reason that occurred was that the Japanese government was issuing 3 times as many bonds as it needed to fund its budget deficit in the second quarter. And as far as we can tell, the only reason they did that was they feared instability in global bond markets in the second half of the year when the US started issuing. The problem was the Koreans did it as well, and the Taiwanese did it, and the French did it a little bit as well. So everybody was trying to get in front of what we expect will be a lot of treasury bond issuance. And in fact, from August, September onwards, estimates range, but I think we're looking at a minimum of $550 billion and perhaps as much as $940 billion of treasury issuance, really from probably the second week of August onwards. And it'll be interesting to see how the treasury market reacts to that.
So what that the picture that paints, and maybe something that it brings, puts more clarity on, is some people worry about higher yields, but also in the context of a slowing economy in the US, it seems somewhat counterintuitive. People have difficulty believing that, but what you're saying is actually yields probably should have been a little bit higher than they are when the US government starts issuing in the way that they have to, given the big beautiful bill. That's when things.
That's what I think we could worry about treasuries, and I think that the historical precedent that I draw people's attention to is 2021. From late 2020 onwards, the call that global inflation was going higher and that US inflation was going higher was actually, as economic calls go, and economists have a certain reputation, but as calls go, it was easy. I mean, I think at the time I did a 20-page report that looked at it in a monetary sense, a fiscal policy sense, capacity utilization. I mean, every single way of predicting inflation was pointing in the same direction. It was probably one of the least equivocal calls you could make in 2021. And what did the Treasury market do? Absolutely nothing, because it was an environment of heavy issuance, but also a lot of quantitative easing. When quantitative easing stopped at the end of 21 and you had that issuance, that was when the bond market reacted. So the bond market was able to ignore inflation going from 3 to 8 until there was issuance, and then it sort of fell apart. And we had the same again in late 2023. The bond market was pretty stable through the most of 2023, and then September it was hit with a lot of issuance, and yields gapped up about 125 basis points. And it's not just the US. We think of the trust experiment, if that's the right phrase, in the UK. The French government last September, October, hitting the market with a lot of issuance, and the market just fell away. So I think these bond markets are very sensitive to issuance, and we could well be providing a little stress test to the US. And also, if you think a lot of those foreign investors have just bought treasuries and then they sell off, Obviously, I think we've all grown a bit tired of trying to predict what the president will say next. But it's possible that we get August, September, the US slowing at the margin. I'm just about to publish a report on US growth. It's moderating. I wouldn't say there's a recession or anything due at this point in time, but we've just seen a little moderation over the middle part of the year. Domestic inflation does seem quite sticky. Import prices have been helpful. So there's not a great reason in terms of the economic data for treasuries to sell off other than issuance. But of course, if we get a lot of issuance, we would expect what economists call crowding out. And how does crowding out occur? Normally through higher real interest rates. And that's sort of what's starting to worry me for August onwards, that we could see nominal yields rise, but also with accelerating deflation in the Asian region, particularly in China at the moment, the inflation numbers could come down a bit as the nominal yield goes up. Very counterintuitive, but also quite painful. And that could make what we think is a very moderate slowdown in the economy at the moment into something more serious. Now, of course, policymakers will react. The occupant of the Oval Office is not going to stand still or keep quiet if he's seeing the economy weaken and nominal yields rising. I think he will get even more vocal. And the Federal Reserve, I think, will probably have to add some financial stability concerns to its list of worries. And I think by the fourth quarter, the Fed would be reacting. Now, I'm sure they're not going to call anything quantitative easing or yield curve control, but you can imagine some form of repression of yields being enacted. Maybe it's just creating a very positively sloped yield curve to get the banks buying even more bonds to do what the European Central Bank has been doing. So I think, arguably the economy has been quite stable and the capital flows have been quite stable. But I think the second half of the year, there's a lot of domestic things going on in the US which might test the patience of foreign investors. And if the president gets a little wayward with his commentary, and I think longer term undermining the Federal Reserve is probably not something you should be doing. It's certainly taking a risk with inflation expectations. Things could get interesting for a while, and then I think we will see a political imperative in the US and elsewhere. I don't think it's any coincidence that the European Central Bank has presided over this quasi-quantitative easing from about 2 weeks after the French bond market fell apart. We do have fiscal primacy, we do have politicians interfering in monetary policy. In the United Kingdom, where the gilt market looks very vulnerable at the moment to any change in global sentiment, I have no doubt that huge pressure will be brought to bear on the Bank of England, but also you've got a government that's actively talking about setting people's asset allocation for them, to do national service and to fund deficits. So I think we could get to the end of this year with the majority actually of the major economies having governments interfering in the debt markets, suppressing yields because they can't close their budget deficits. They've got to find a way of funding them. They've got to involve the central banks and the commercial banks in the funding. They've got to monetize these deficits or real yields go up. Now and then, initially at least, I think equities will probably quite welcome that. Longer term, it's going to give you inflation. But that longer term is normally about 18 months.
And that's when you see the rotation maybe into assets that have a bit more inflation protection, a bit more yield support, a bit more pricing power, which is probably very different from the portfolios that have benefited from low rates during the last 15 years.
Yeah, and the last 5 or 6 weeks.
Yeah.
Because we've gone, and I referenced Goldilocks just now, and I think we have been in a Goldilocks environment. The US has got some domestic inflation offset by Chinese deflation. There's plenty of liquidity because the government's been running down its cash balances and that lifts liquidity, and foreign investors have been continuing to provide the fuel for US exceptionalism. So the world didn't change in late January, but it might the foundations of that old world could get tested, I think, in August with this issuance, just as they did in September 23, just as they did at the end of 21. I suppose the advantage in a way of being back in this old world is we know what its vulnerabilities are. We know where it's fragile.
So to summarise, there's a sense of inevitability that you will get the issuance, you will get the reaction in markets, you will get the reaction from policymakers, and then you probably get the inflation. So we kind of have a base case.
We have a roadmap, we have a base case, and there's the real yields rising is probably a bit of a deflation scare for markets, and we know how to play that, and then you have the policy reaction, so you buy the reflation and then you worry about the inflation. I suppose the curveball in all of this is, what if the president does get the Federal Reserve to prevent yields rising before they've even risen? Now that seems very unlikely, but I guess if we've learned anything this year, nothing is impossible.
So something I'd like to put by you, I've just asked the AI what that means for certain type of investors. Kind of a question without notice, and it's certainly not advice, because after all, we just asked the AI based on your observations. But I think it is interesting because it gives you a playbook, something which you can, then change your mind about later. But say for an accumulation investor in Australia with a sort of equity biased portfolio, thinking about, and there is this sort of buy on the dip mentality in markets, and probably it's best not to fight that too much. But even let's say if with the Lions out in Australia, using a rugby analogy, you're trying to win, you're trying all the time, but sometimes you're trying a little bit more than others. It sounds like this is one where you conserve your energy. If you are going to tilt a little bit, you keep a little bit of cash on the sidelines, let it build up, because there might be a better chance to deploy it later. And then what you deploy it into is perhaps the things that are different, more, and that's the back end of this year. Does that sound like a sort of reasonable playbook?
Yeah, I think, to use another rugby analogy, I think you probably try and win ugly. You're not trying to get beautiful tries from the back row, let the forwards pick and go and gain a few points here, hold possession. Yeah. Hold on to the ball. Yeah. Don't no Hail Mary passes sort of thing. There probably will come a time for just you're on your goal line with defence if we do get the rise in yields. But then I think the field could open up a bit in a reflation trade. But your ultimate goal in that reflation, I think, you've got a number of key things to do here. You've got to keep the pick and goes going, and then know when you're on defence, and then perhaps be a bit more expansive in the reflation, and then that switch into protecting yourself from inflation on a 3-year view.
And that's looking out to the long term. It's the inflation hedges. It's probably equity orientated. It's probably some of the countries that you've talked about in Southern Europe, in South America.
And some of the alternatives are in there, and there's some favourites in inflationary times that I guess will attract flows, and you've got maybe some of the crypto universe appears interesting in that. There's a lot going on in crypto at the moment, so I think that becomes a presentation in its own right. I don't know how much press it's got, but now we have a major US bank offering deposit tokens. I think they may have just eaten the conventional stable coins lunch. So that to me was quite a big game changer, and the stable coins probably have to evolve into doing something else, and then you've got the more speculative crypto assets.
So that's something, like you said, subject for another presentation, and maybe something we'll learn about sort of later in the year, I suspect, with a long-term bias. A bigger cohort, increasingly in Australia and elsewhere in the world, a retiree or someone approaching retirement with, say, a 50-50 portfolio, probably got to be a little bit careful about how much duration they have, and then at some point about the return of capital as much as the return on capital. And again, trying to find, I guess, inflation protection.
Inflation and protection is going to be important. If we think back to the 1970s, it was at the end of the 70s that the retirees were impoverished by inflation. And that's clearly, it was the second spike in inflation in the 70s that did the damage to people's portfolios. people tend to think of the equity market crash in 73 and the weakness 74, 75, but for the fixed income guys, it was the tail end of the decade that was difficult. And there's probably an incentive, I would have thought, to lock in some high yields if you do see real rates rising. What's wrong with income?
And here's an interesting comment from the AI, which might be popular. Dividend-paying commodity producers. I wonder where you'd find a few cheap ones of those. Is that is that the banks are very expensive? I guess that's where you could see some of the issues. Might some of the local commodity producers?
I don't see why not. I mean, they don't necessarily have the world's greatest reputation for managing their businesses, but they're going to have a following wind.
Right. Yep.
And I think some of the banks, there's a lot going on within the world of chief risk officers in the banking sector at the moment, which probably tells you something that if the world, the banks have a business model that has made them a lot of money in the last 35 years of expanding capital flows and low yields and intermittent quantitative easing and low inflation, that to maintain their momentum, they have to change their business models. And particularly, I mean, those that have big emerging market exposure, which probably does include some near here. I think over the next 5 years, we'll move away from a world of stable nominal exchange rates and foreign exchange reserve accumulation at the expense of domestic instability, that more governments will choose domestic economic stability and financial stability within their own borders, and the currency can find its own level. And that'll be a challenge to some of these banks, who many of them, I think, particularly talking about Australian banks here, I'm talking about in other countries in particular, have just become glorified carry traders. They just see a high yield and buy it, and assume the currencies will be stable. And those cross-border transactions, I think, could start to blow up on them.
Okay. Final cohort, the opportunistic investor with a bit of cash, end of year end. Sometimes people get their tax bonuses, and interestingly, they are saying here is in the best position according to Hunt's timeline, because if you've got cash, you're going to get opportunities to deploy it. And a couple of comments here that it's come up with: beaten down emerging market currencies with hard currency potential. That's probably a bit of a medium term.
That's a medium term, and the economists have got to earn their living identifying those. But they, I think, could become not just they become a profitable investment, but also, I think, more importantly, a store of value in a world of inflation. So actually, maybe some of your retirees might start to think about actually which country is going to protect the real value of my capital in this environment.
So you have to be a little bit more discerning.
And if you've got cash, then I think opportunities will arise.
So you're looking for
but trading these markets is going to be, I think, difficult. Really going to have some tight limits, because politicians are saying the strangest things.
Which brings me to the last point, that actually, and there's some contingency to all this, you might well end up, there's an element of regime change, end of US exceptionalism, but the can could be kicked, one almighty kick further up the field, if we do have some kind of yield curve control and a massive inflation trade.
I think we thought we'd reached the end of the road, and that the repatriation trade these deficits being unfunded could have been the end of the road, but Chinese deflation that has provided enough of a depressing or suppressing impact on inflation rates in the West that, lucky us, central banks can have another go at QE. I mean, we know that this is a very flawed model. It creates household wealth inequality, low productivity growth, Even the Financial Times is having to start talking about some of this stuff now, that there's the long-term consequences of the policy response to the GFC, and I'd actually say to the Nasdaq burst and the LTCM bubble before that, has not created a great world for your median household, but the markets have loved it, and China's deflation potentially gives them another 18 months.
So, look, I think what we're left with is there's a fair amount of conviction about what could happen in quarter three, but then after that, the fan opens up a little bit, and we'll talk about it later in the year. And in the meantime, I think despite just getting off the plane, you've got a full day of meetings, and I better let you get on to the next one.
On to the next one. But thanks for that. Good to see you again.
Thanks, Andrew.
Maybe the sun will come out.
I hope so. Talk soon. Thanks.
Bye.
All right. I know you've got to get going. Anyway, if you did shorter answers,
That would help. Help.